This video is about how you can invest your first $10,000. Some of these things are not as obvious as buying Tesla, but they're important to make sure your investments make you more money, not less, so let's go through it step by step. With this crazy inflation, money is losing 10-20% of its buying power every year, which means that if you keep money in cash, by the time you retire, all your savings will be worth almost nothing. So in case you haven't started investing yet, maybe you just lost a bunch of money, let's look at the main ways you can and should focus on to get your investment portfolio in shape. Build an emergency fund and pay off high interest debt. So the first thing you should do is look at your financial situation. Hopefully you already have some savings in cash and you don't have any high interest debt. But if you don't have cash and you do have debt, then it's a bit early to think about investing, my friend. Now, some people say you should first pay off your debts. Some will say first build an emergency fund, but really this will depend on your situation. What's an emergency fund? It's 3 to 6 months worth of your living expenses in case of, you guessed it, an emergency. Because when something like that comes along, you don't want to be selling your stocks or other investments that might be 50% down at that time. And if you have high interest debt, paying it off has the best return on investment you can imagine. The average credit card interest rate is around 20%, but some retail credit cards charge you 30% or even more in a year. You're very unlikely to get returns like that in a year with any investment on average, and you'll be taking away that burden as well. So pay off those debts and build an emergency fund first. And by the way, if you have $10,000 in your emergency fund, it might be best to just keep it there. You can put it in a high yield savings account. Because the Fed raised rates 7 times in 2022, you can get between 3 and 4% a year. So of course you're still losing money to inflation, but less slowly, and you have money for emergencies. Good. And now you can invest in Tesla again. Just kidding. Now of course it's never too early to start investing. So feel free to put a bit of money in each asset, but that's only if we're looking at it as learning rather than an investment strategy. So after you've paid off your debts and have some cash available for emergencies, the next thing is to open a retirement account like an IRA or a 401k. An IRA lets you make investment contributions for your retirement up to a certain amount. For 2023, this is $6,500 or $7,500 if you're over 50. There are 2 types of IRA, traditional and Roth IRA. Traditional means you make tax-deductible contributions so your tax bill goes down, but you will have to pay tax when you start making withdrawals in retirement after the age of 59.5. A Roth IRA means you make contributions with after-tax money, but you won't have to pay any tax on your returns after you retire. So both are good, and you can have both types of accounts using the same allowance. If you're in official employment in the US, most likely have the option to make contributions to a 401k account, which also has a traditional pre-tax version which brings down your tax bill, and a Roth version where you don't pay tax when you make withdrawals. The coolest thing about a 401k is the employer match, when your employer will match your contributions up to a certain amount, typically 50% on the first 6% of your salary. So let's say you make $100,000 a year, you put 6% of that in a 401k, you'll get the tax benefits as well as a 50% match from your employer, which is $3,000. So this is free money and you should take it. However, above 6% of your salary, you won't get employer contributions, so above that, maybe it's not worth it. 401k investments are very inflexible. You can't withdraw them until you reach retirement, and you have to pay tax and penalties on early withdrawals. You usually have a choice between a handful of different mutual funds, and the funds themselves might be costly. So maybe it's a good idea to get the free money on a 401k, then put the rest in an IRA account and you're good. That's 10 grand well invested. If you've already done the above, or you don't want to be tied to a retirement account, you want more flexibility, next up we have Warren Buffett's favorite investment recommendation for beginners, Tesla. No, not Tesla. Index funds. The most common one is SPDR S&P 500, ticker SPY. This tracks the 500 biggest companies in the US, essentially the whole market, and you can buy it just like any other asset traded on the stock market. The difference between an index and an index fund is that an index simply tracks the market and it's like a measurement tool, while an index fund is an asset you can invest in. Historically, this has been one of the most robust and reliable investments, especially for beginners. SPY is very, very cheap. It only costs 0.095%, which is less than 1/10 of 1%, or $10 a year if you were to invest the whole 10k in it. The S&P 500 outperforms the majority of actively managed funds, and if you take into account the fees as well, If you go for an actively managed fund, you might end up losing money versus just buying the S&P 500. The interesting thing about that is that instead of investing in the decision of specific fund managers, you are buying an asset that tracks the whole market with all the price movements and all the decisions and collective intelligence, so it's very hard to go wrong with it. So that's a great foundation for any portfolio, and you can add additional ETFs for other geographical areas or specific industries. If you want more information about how to build an ETF portfolio, check out our video on this topic. Build a stock portfolio. Once you have a good foundation with savings, possibly retirement accounts, possibly an index fund, maybe you want more flexibility and control, so the next step is building a stock portfolio. This comes with more potential reward and is more risky. For beginners, it's best to stick to big companies with proven business models that can withstand big shifts in the market. Of course, this doesn't mean that their stock prices will always grow, but over a long period of time, they mainly do. Then you have smaller companies, mid-cap, small-cap, international companies, companies in a developing industry that you believe in and want to support. Here you're going down the rabbit hole of risk versus reward. Stock picking is a massive topic, so if you're a beginner, unless you go for something obvious like Apple or Alphabet, or another huge blue chip company that we can rely on, there is just too much to talk about, so we won't. If you want more control over your investments, but you don't want to pick individual stocks, you can try thematic stock collections. ETFs are often very broad and they contain a lot of companies you won't know anything about. And they also have confusing names like Consumer Discretionary Select Sector, which to most people doesn't make much sense. With thematic trading fractional collections, you can pick model portfolios usually made up of 10 to 15 companies around themes you like, for example, AI, semiconductors, and so on. These are automatically rebalanced, so you won't have to do much about them. It's a low-cost, hands-off approach. It's like investing on autopilot because you don't have to readjust the portfolio, but you'll be making your own decisions about what to invest in without getting into too much detail and research. You can also try different investment strategies like inflation-proof or monthly dividend portfolio. So check out TTF collections in the Gainy app and see if there's anything you like there. It's good for research and learning about the best companies in all the fields. So wishing you all the best. Hopefully this has been helpful on your way to smarter investment decisions. Good luck and see you soon.